Defense startups have seen an influx of venture funding in the past year, and two ongoing conflicts could propel innovation even further. Joining us right now is Michael Fertik, a futurist, serial tech founder, and founder of Heroic Ventures, a VC shop investing in AI and machine learning. And sure, there has been a lot of money going into defense. The question is, are we in some kind of defense bubble, or do you think that we are now walking into a trend, which therefore is to some degree scary for society if you think over the next 10 or 20 or 30 years, we're going to need a lot more money in this space, Michael?
Good morning, Andrew. Nice to be back. For better or worse, I think this is a trend. This is durable. This is either the continuation of Cold War II or, God forbid, the beginning of World War III. This conflict in the Ukraine especially is stimulating both the United States and especially Europe to spend more. So you saw that at a NATO, we saw a bunch of member countries committing finally to their 5% of GDP spend level. We'll see if they actually do it. But to be sure, the machine is back on. The war machine is back on. And that's creating a pull in the market for the entire supply chain of defense, which includes increasingly startups. Another thing has happened, which is that finally in America, a kind of cultural aversion in Silicon Valley among too many of my brethren and sistren, in my opinion, a cultural aversion to supporting American defense is starting to become less important, become less prominent. So culturally, we're ready to start investing in defense. So I'm actually very bullish on the sector. I think if you believe in Western values and Western safety, I think you have to also be bullish on the sector as a matter of patriotism. But from a commercial point of view, I think the pull is back on in the market, and that's very, very important. And by the way, the numbers are bearing it out. Yeah.
But Michael, is that because you think there's going to be more money total spent on defense, or because you think that there's going to be effectively a reallocation towards more efficient, higher tech, drone-oriented and AI-oriented defense companies that are producing these type of products relative to the more traditional legacy players, or because the pie expands even more?
Yeah, both. It's a sort of a Jedi level question, actually. Both is the answer. So there are two major problems. One is how much is being spent, and I think increasingly Europe will spend more, America will spend a little bit more, but America's been spending a lot. But two, the procurement cycles are very, very brutal for startups. So NATO's procurement cycle is about 17 years. The U.S. Department of Defense's procurement cycle is about 7+ years. I met last week with Senator Tim Sheehy from Montana in D.C. He's spearheading an effort to reduce and rationalize procurement cycles, because those procurement cycles are fatal for startups, right? If you tell your investors, well, we might have a customer in 8 years or 10 years, we just might, they might laugh you out of the room. So those procurement cycles also have to be rationalized, because without a rationalizing of the procurement cycles, the United States will not benefit from the brightest minds in startup world, the brightest minds coming out of the best universities, making the best weapons. So, like some of the new weaponry will be cyber, they'll be digital, they'll be AI. Some will be sort of lighter than traditional aircraft like drones, but it'll all be spent. Yes,
look,
Becky.
Part of the reason that the cycle works that way is because we don't necessarily want to deal with too many startups with the risk of failure to that. I mean, the United States government has to make sure that these are going to be companies that have legs, that can stick around. And while it might be okay to work with a startup every once in a while, I mean, part of the way it works is startups get bought by bigger companies to make sure that defense technology sticks around, and we're not spending on something that suddenly has nobody who's building it out anymore or who can support it.
Well, durability and sort of the life expectancy of a startup is sort of one of the many considerations. But listen, I've over the last 10, 12 years, 15 years, I've spoken with maybe 100 people in the demand chain of defense in one way or another, and I can't tell you that any one of them has said that that the life expectancy of startups is one of the top 10 reasons that they don't use startups. It's usually just sort of bureaucratic bungle. You have a lot of very well-intentioned, very bright people in the demand chain of defense. I'm repeatedly impressed, actually, with the quality of people. Sometimes we imagine that bureaucrats are faceless and incompetent. I'm repeatedly impressed with how competent they are. But they also feel sort of beholden to a bureaucratic process that no one is really responsible for, like the multi-headed hydra, where no one really has the decision-making authority or responsibility for failure. There's a lot of fear of being fired if you make the wrong choice. There's also in the military, as you can understand, no financial incentive to get it right. So in the commercial world, in enterprise, in B2B, in retail and consumer, you have a financial incentive to succeed if you're a buyer, if you're a vendor. Right. In the military world, you don't have that financial incentive. You have a career incentive. And so this is the natural outcome of the way defense departments are run. No one's doing anything wrong, but everyone agrees we have to do better. And so, look, if you have a better weapon that a startup can make for $50 million, and that's competitive with a weapon that a traditional company make for $5 billion, that's a trade-off that's certainly worth considering for everyone.
Hey, Mike, can I ask you a broader question about just the venture capital and private equity industry right now, which is, it was a fascinating piece. I don't know if you saw it in the information. I think it was over the weekend or maybe late last week, just about how much money is tied up in the fact that so many of these companies have remained private, have not actually had an exit. So few of the big money pension funds in the U.S. and frankly, increasingly even in the Middle East and others have not had the exit moment. So there's no cash coming back to them. And it's just making the entire sort of fundraising machine and ability to fund some of these projects that much more challenging. And whether we're getting to a situation where everything is getting locked up and you're seeing people even taking discounts to create these sort of secondary moments to create some kind of exit, but not at the kind of valuations that at least some of these companies are trying to keep on their books?
It's an extremely important question. I think it's the biggest crisis facing VC and private equity now. They're different animals, but they're similar in nature with long hold times, is this lack of DPI, of distributed capital, right? And so, in fact, your timing is remarkable. On Friday, I sold a position in one of our startups that we've invested in. I can't tell you which one, but that will, in fact, return the entire fund that first invested in that company. That fund is only 5 or 6 years old. And I did it because LPs all around my world are complaining that in their entire ecosystem, they're not getting any cash back. And I said, hey, is this a chance for us to be heroic and return cash and return a whole fund, and everyone gets their principal back in 5 or 6 years, which in early stage investing is very unusual. But this is a conversation that comes up all the time, the illiquidity. And by the way, I'm hearing this alarming phrase that's coming from some of the big guys, the big Wall Street players who are major 100 billion plus asset manager, 500 billion plus asset managers. The concept of private forever, which is an enticing idea that you as a founder can stay in charge forever. You can stay in the position of authority forever, and maybe once in a while your employees get a buyout. It's very, very alarming because our industry depends on liquidity, long-term liquidity, but liquidity to pay back those distributions. I think it's an enormous crisis. I'm seeing it in the behavior of continuation funds of private equity, in the lack of demand for certain kinds of VC classes, in the extension of the lifetimes and life cycles of these funds from 8 years to 12 years to 15 years. I'm seeing it in the compression of certain fees. And so it's very, very interesting. And I've just been acting accordingly. And it's very, very interesting. Right. You're like the 9th person I've told. Now I've told the world that we just made the sale on Friday.